This video continues our journey from the last part, where we sorted out your credit cards and built a strong foundation for smarter spending. In this part of your personal finance series, we shift into the next major piece of your financial system, your bank accounts, the backbone of how your money moves, grows, and supports your goals. Today, we're going to walk through why your bank selection matters, how fees quietly drain your money, the difference between checking and savings accounts, why using different banks can be a surprisingly powerful move, and finally, how to optimize your setup so everything works smoothly in the background. By the end of this discussion, you'll not only understand what accounts you need, but you'll know exactly how to build a system that supports you without constant effort. And after each section, I'll guide you smoothly into the next point so the flow stays easy to follow. So let's jump in. After getting your credit cards right, the next natural question is, are your bank accounts working for you or against you? Bank accounts are often overlooked, but they quietly shape your entire financial life. If they're set up poorly, maybe with high fees or outdated features, everything else feels harder. If they're set up well, they support your goals with almost no work from you. The good news is that creating a strong account structure doesn't take long. A few hours of organized setup can put you ahead for years. But here's the tricky part. The bank you're using right now might be costing you money without you realizing it through minimum balance requirements, maintenance charges, and service fees. These small hits add up, and many people don't switch simply because it feels inconvenient. Right after understanding this reality, the next thing to explore is how banks behave. Most industries grow by treating customers well. But big banks often behave differently. Some of them have long histories of charging unnecessary fees and complicating simple services. Not every bank is bad, but many rely heavily on customers staying put out of habit. That's why the smarter approach is to choose banks based on their behavior, not their size, advertising, or convenience. Good banks offer clear terms, modern tools, and fewer gotcha fees. Less consumer-friendly banks build profits around customers not paying attention. And even when people know this, many stick with the same bank for decades. Understanding why banks are structured this way leads us naturally into how they actually make their money. Most people know that banks earn interest from lending out your deposits, but the real engine behind their profits is fees. Fees for overdrafts, fees for account maintenance, fees for using the wrong ATM. Overdraft fees in particular can be shockingly expensive. Imagine you accidentally overspend by a few dollars. Instead of declining the purchase, many banks allow it and then hit you with a fee large enough to cancel out months of interest you might have earned. And if multiple small purchases hit on a low balance day, you might get several fees in a row. These charges drain millions from consumers every year and hit hardest for people just starting out. Knowing how painful these fees can be, it makes perfect sense why the next point is all about the emotional and psychological barriers to switching banks. A lot of people stay with a bad bank simply because switching feels like a hassle. Changing direct deposits, updating bill payments, and learning a new app all sound time-consuming. Sometimes it's even emotional. It might be the bank someone opened their first account with, but that single day of effort can protect you from years of fees and frustration. Modern banking tools in the US, UK, Europe, and many other regions make switching easier than ever. Many banks provide automatic transfer tools, clear setup checklists, and reminder prompts so nothing gets missed. And once everything is connected, your accounts basically run themselves. Now that the psychological side is clear, the next step is understanding the accounts you actually need. Starting with checking accounts. Your checking account is your money's home base, the inbox where everything lands before it's sorted to savings, bills, or spending. Because it handles frequent transactions, the priority here is avoiding unnecessary fees. No monthly fees, no minimum balance traps, and modern conveniences like mobile deposits and reliable customer support. Understanding daily money flow sets us up perfectly for the next point: savings accounts and how they differ. Savings accounts exist for short-term to mid-term goals, vacations, gifts, an emergency fund, or a down payment. They pay more interest than checking, but the difference varies widely. Traditional big banks often offer extremely low rates, while online banks tend to offer much higher ones. Even small differences in interest rates can help your money grow more efficiently over time, though savings won't replace the power of investing. Still, a good savings account is essential, and that leads directly to the next idea: why you need both checking and savings, and why keeping them at separate banks can be a psychological game changer. Checking is for everyday spending. Savings is for goals. Keeping them separate prevents you from dipping into money meant for the future. If your savings sits inside the same app as your checking, it can be tempting to move money around for impulse purchases. But if your savings is at a different bank, that slight delay makes you think twice. A small but effective barrier. This helps protect your long-term goals. With that separation explained, the next question becomes how to choose the setup that matches your personality. Some people prefer simplicity, one checking and one savings, both straightforward and easy to manage. Others enjoy optimizing, pairing a no-fee checking account at a local or national bank with a high-yield online savings account. And then there are advanced users who maintain multiple accounts for different purposes or to take advantage of specialized features. The sweet spot for most people is a simple setup with a small optimization, easy to manage but still efficient. With the framework in place, the next step is real-world recommendations. For checking, many people like accounts that avoid fees and reimburse ATM charges globally, which is especially helpful for travelers or anyone living in regions where ATM networks vary widely. One well-known example is an investor-focused checking account that offers broad ATM reimbursement and no maintenance fees, though it typically requires opening a companion brokerage account. Many people also pair this with a local bank account if they need to deposit cash occasionally. For savings, online high-yield accounts shine because they offer strong interest rates, sub-accounts for organizing goals, and straightforward terms with no minimums. Options like online-only banks give people in the US, UK, and Europe modern tools, clean mobile apps, and faster transfers. With those choices noted, it's time to move into account optimization. Optimization means making sure you're not paying any avoidable fees. Many accounts with fees can be switched to no-fee variations simply by calling customer service and asking about requirements like direct deposit. A quick conversation often unlocks fee waivers or upgrades. Minimum balance requirements can also be avoided. There's rarely a reason to tie up money just to dodge a fee when that money could be earning more elsewhere. If a bank won't waive fees, switching to a better option is usually the smarter move. And since fees are such a recurring theme in banking, the next point naturally leads into fee negotiation. Bank fees, especially overdraft charges, can often be waived if you call politely and explain the situation. Many banks allow at least one courtesy waiver, and long-term customers often have even more flexibility. Keeping a small cushion in your checking account and using automatic transfers can help prevent overdrafts in the first place. But mistakes happen. A respectful phone call can save real money. With the system optimized and fees under control, it's time for the final point, your action steps. This week, take an hour to evaluate or open a no-fee checking account. Then spend a few hours opening an online high-interest savings account. Optionally, if you're feeling enthusiastic, explore an online checking account to pair with your savings. After setting up your accounts, move your money into place. Keep about 1.5 months of expenses in checking as a buffer, and transfer the rest to savings. Even a small starting amount builds the habit. And now you've built the backbone of your financial system. Next time, we'll continue this journey and move into the exciting world of investment accounts. To wrap up, here's a quick summary of what we covered. We explored why traditional banks often cost you money, how fees drain your finances, why switching banks is worth the effort, the role of checking and savings accounts, why it's smart to separate them, how to choose the setup that fits your personality, which types of accounts perform best, how to optimize and negotiate fees, and finally, the action steps to build your account system confidently. Thanks so much for watching. If this helped you, make sure to like, subscribe, share this with someone who could use it, and join me for the next part. Let's keep building your financial confidence together. See you in the next one.